Good afternoon. Thank you for joining us for today's webinar, Avoiding Penalties When Changing Your Domicile for Tax Purposes. I'm Bob Sharon, partner and leader of the firm's tax practice. I'm pleased to introduce you to today's presenters. Tom Corey is a principal at Friedman and director of the firm's state and local tax group. He has more than 30 years of experience. Tom has worked with clients in a broad array of industries and advises high net worth individuals with respect to both their personal and business state and local tax matters. Joining Tom is Alan Goldenberg, a member of the state and local tax and tax controversy groups. He focuses on tax transactions, including structuring, advisory tax services, and tax controversies. Alan has more than 10 years of experience representing taxpayers before the IRS and local tax authorities. Friedman is a leading provider of accounting, tax, and business consulting needs of public and private companies since 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry and all regions where we operate. Friedman's State and Local Tax Services Group is dedicated to helping clients avoid pitfalls and maximize their tax position in light of widespread tax changes. We are pleased to bring you programs such as today's Domicile webinar, and will continue to share insights to help you navigate the complex and evolving tax landscape. The goal of today's program is to help you minimize your exposure to potentially significant penalties for non-compliance with domicile and statutory residency laws in the face of increased state enforcement. Our state and local tax experts will provide guidance on how to properly implement the change in domicile and reduce your state personal income tax liability. At the conclusion of the webinar, we will attend to questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the Q&A feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you on a one-on-one basis to better guide you on your particular situation. At this time, I am pleased to turn the presentation over to my colleague, Tom Corey, who will kick off the program.
Thank you, Bob, and thank everyone for joining us this afternoon. We chose this topic, domicile and to a lesser extent statutory residency, very carefully because it's a topic that both Alan and I receive questions on all the time, and we deal with numerous audits with a variety of states in this area, and it's a topic about which many folks have questions. Domicile is quite an important concept in personal income tax law, as the domicile state has the right to tax all of your income subject to certain credits and other things. Domicile is a primary factor in the tax world, and an individual can only have one domicile. He or she can have many residences, but there is only one domicile state, and we'll expand on this further. But the domicile state in general is a state in which the individual intends, and that's in the subjective intends, to be their permanent home. Alan, you want to talk about that a little bit?
Sure. So, you know, as you mentioned, domicile and residency for tax purposes, the reason this is vital is due to the fact that one's resident state has the ability to tax a resident on all of their income that's earned. This also extends to estate taxes as well, whereby the resident state, those that do have an estate tax, can enforce their estate tax on their residents for that purpose too. As opposed to a foreign state where one earns income in another jurisdiction, that foreign state can't tax all the income of the non-resident, rather only the income that's earned in that particular state. In light of this, with respect to the TCJA and now the limitations on state and local tax deductions, this residency has become all the more impactful because high taxing states such as New York and California and New Jersey really burden local residents because of the inability now to take the federal deduction for the full state and local tax that's paid by the residents.
Yeah, Alan, and in light of that, we're getting a lot more questions about people seeking to potentially change their domiciles. They are now facing the burden of not being able to really deduct their state and local income taxes paid, their income taxes, their property taxes, etc., on their federal tax return. So the impact of the higher state taxing jurisdictions has been increased tremendously.
And states know this, and they've increased their audits as well. Certain states are super aggressive when it comes to taxing individuals who at one time were residents and now have become non-residents. Just by way of example, in the last 5 years, New York has conducted over 15,000 residency audits, which have generated close to $1 billion in revenue. So it's a highly profitable area for taxing authorities, and one that we certainly will see more action, in the future.
In fact, New York has, and to a certain extent, New Jersey, I think, also have beefed up their agents that they've applied to the personal income tax area, and I think it's going to keep happening and increasing in light of the federal limitations on the ability to deduct taxes now.
All right, so Tom, let's jump into a couple of states that we see often with respect to our clients, and we'll jump into some of the rules regarding residency. The first one up is California, and we'll see this pretty often. There's a common theme whereby, as Tom mentioned at the outset, you have a domicile basket and you have a residency or statutory residency basket. Oftentimes, the statutory residency basket will fall into one of two categories. One is a day count. People think of 180 days, 183 days, 6 months. The other one is similar to what we have here for California, where there's a temporary or transitory type test as to the purpose of what that individual is or is not doing within the state. So for California here, you can see that the first prong is the residency test, and then the second prong is the domicile, whether that individual has the intent to be a California resident or not. And as the presentation goes on, we'll delve more into the meaning of each of these terms.
Again, going to some specific states now, Connecticut resident is an individual, obviously, who's domiciled in Connecticut. For the most part, if an individual is domiciled in a particular state, subject to certain very limited exceptions, day count is not really relevant. So if you are domiciled in a state and you're only spending 100 days there, and you're spending, let's say, the rest of your time in Florida or South Carolina or whatever, as long as you are domiciled in Connecticut, Connecticut will take the position that you are subject to tax on, in essence, your worldwide income in that state. Some people confuse the concept of domicile with statutory residency. You have to be careful of that. Two different concepts. Statutory residency, as Alan mentioned earlier, usually has to do with a certain day count or a certain period of time. Domicile is a question of, frankly, subjective intent, which is often evaluated by the states by viewing objective criteria. Again, subjective intent, but they evaluate that subjective intent by reviewing on audit objective criteria. Alan?
Yeah, so we'll continue with some of the other local states that we regularly see. The next one being New Jersey. Again, they have their domicile rule. And then with respect to statutory residency, New Jersey has a 183-day rule. That means a taxpayer that has a permanent home, a residence, a condo, an apartment, whether they own it or lease it, and they are present in the state of New Jersey for more than 183 days, they would be deemed to be a statutory resident. Why statutory residency is important? An individual can have separate state of domicile and a separate state of statutory residency. What that creates is a dual residency situation. And as I mentioned at the outset, a state where one is a tax resident of can tax the entire income of the individual. So if one is a domicile of one state and a statutory resident of a second state, both states can tax the entire income, earned income as well as passive income of that individual.
And you can often sometimes get whipsawed in the sense that you're not able to get credits in your domicile state for the taxes that you're paying with respect to your resident state, your statutory residency state, so that the states are taxing both your earned income and your, frankly, income that's generated by intangibles. And we've had situations on audits where people are involved with the two states that do not have reciprocal laws in that regard, and folks can get burned pretty badly.
Moving on to Pennsylvania, you can see that their provisions are in line with New Jersey. You have a domiciliary aspect and a 183-day count rule as well.
Alan, we should say that we do list there are certain exceptions. New York has a little bit more, but some of the states have exceptions. But those exceptions are pretty tough to meet oftentimes, and not really relevant in most cases that we've seen. Alan, you want to jump to New York?
Yeah, New York, Tom, is one of the states we probably deal with most with respect to residency, and the reason being is New York really has a whole dedicated department within its Department of Taxation that goes about auditing residents or non-residents, and we're in touch with them on a regular basis for a number of audits, and primarily the big one that we have to contend with is domicile. As we'll delve into, domicile for New York purposes has a number of tests that are out there that auditors will look to determine whether an individual is in fact a domiciliary of the state of New York. Interestingly enough, the city of New York follows the same provisions. So one can be deemed or be subjected to, I should say, a New York City audit, which would test the similar thresholds that the state has put out there.
Yeah, and usually, again, when we're seeing audits, and it's, I think in most states where you've got domicile and statutory residency issues, upon an audit, the state will first attempt to get down the domicile issues, so that if they can prevail on a domicile audit, then there really isn't a whole heck of a lot of need for them to pursue statutory residency. So if the taxpayer prevails in domicile, showing and demonstrating that they have basically changed their domicile, and by the way, I want to make it very clear that the taxpayers have the burden of proof of showing and demonstrating that a domicile change has occurred. And in New York anyway, and I think in most states, that burden has to be carried by clear and convincing evidence, which is a pretty high burden to carry. The other next thing is once if the taxpayer prevails in the domicile issue, the agent will then turn to address the statutory residency issue, which is much harder for the state to prevail on because there's a time element and everything else involved. Alan?
Sure. So as we've been mentioning throughout this so far, we have the two tests that have to be contended with in a residency audit. First being domicile. You can see the first bullet point here is intent. It's always about the intent of the taxpayer, and that's what needs to be proven. And the second aspect is the statutory residency part of things, and that is more of a bright line test. Either the taxpayer exceeded the requisite number of days or fell below the requisite number of days for residency.
One thing I think is important, we may talk about it again later on, but when we say greater than 183 days, we're talking about any part of a day spent in a state is considered an in-state day. So that you could have situations where someone may leave the state at 11:55 or on one day, figure that they wouldn't be there at all, and in fact, arrive in the state rather at 11:55 on a day and spend 5 minutes in the state and say, well, that can't count as a New York State day. What it does, because you're in state for 5 minutes. And I've had actual audit situations where gentlemen would take a train ride out of New York City on 6 o'clock in the morning on Saturday morning after having worked late on Friday night, and get back into the city on Sunday night at about 11:50, and both of those days for state tax purposes were considered New York State days, and he got caught for statutory residency. Alan?
Yeah, so let's delve a little bit into domicile and the various aspects of it upon taxpayers. Domicile is the one true home of an individual. It's their place where they return to after a trip. It's the place where they live their lives primarily out of, and for the most part, you can only have one place of domicile. Unlike statutory residency, which because of partial days, you can have multiple states of statutory residency, depending on the facts, domicile is one state. And really, for a taxpayer to show that their state of domicile has in fact changed, you really need to show a life-changing event. Something major has occurred, their pattern of life has changed, or in fact, they've replicated their pattern of life somewhere else because of some circumstance that has occurred. Oftentimes, Tom and I find the best way of explaining domicile and the factors that are involved is really through a story. We like taxpayers to tell us all the facts and circumstances that have occurred leading to their change from state A to state B, and by putting those together, we're really able to develop almost like a movie as to what occurred in hopes of proving that they have in fact changed domicile.
Yeah, and we list here that it's often easier to succeed in a domicile argument when you can show that the taxpayers were undergoing some significant life change event, a retirement, a marriage, a divorce, unfortunately, someone passing away, that type of situation where you have a life-changing event. The states are much more likely to agree that there's been a change of domicile occurring. When Alan says we like to tell a story, what we like to do is get a comprehensive history of the taxpayer's life leading up to the decision to the change of domicile. If in fact, for instance, we can demonstrate that individuals have been taking rather extended vacations down in Florida, for instance, which is a no-tax state, over the course of years, and had been dreaming of moving there when they, could cut back on their work-related activities or retire. It becomes much easier for us to convince an auditor that, in fact, hey, this is something that they have been contemplating, they have been intending to do over a course of years. Alan?
Let's delve into some of the New York tests that they have released. New York being one of the states that has released the most amount of information regarding their domiciliary thresholds. Other states we've seen do follow suit to this. to either a greater or lesser degree, but this gives you listeners out there some idea as to what states we'll be looking at when they do test domicile. So the first point here, and New York has 5 of them, is the home. And for that, the state will look at the value of the home, the size of a taxpayer's home, and how they're using their various homes. Often, this becomes a biggest factor in a domiciliary case when the taxpayer has not sold their original family home. Oftentimes, we have clients that have lived in a home in New Jersey for some 40 years. They've raised their family in that home, celebrated holidays and birthdays and anniversaries in that home, and they're reluctant to sell the home, or financially they don't have to. And that's something that states often look at and claim that, hey, you've kept your primary residence here. You really haven't moved out of our state. Your intention is to maintain your living in the current state, and it's only a vacation or for you to escape some harsh winters to go to a state like Florida or Nevada, which has 0 taxation.
I think, Alan, just by way of explanation, a typical fact pattern that we sometimes see is someone has a nice home up in New Jersey, as Alan says. It may be worth $1.5 million to $2 million. They've lived in it for 40 years. They're very happy there. They have a lot of connections in the area. They decide they want to spend a significant time down in Florida. So they buy a $500,000 condo down in Florida, which is pretty nice and meets their needs since they don't have children living with them any longer. Now the state comes in and looks at this and analyzes it and says, hey, wait a minute, you're living in your historic home. That home is very large. It's worth $2 million. You purchased a much smaller home down in Florida, and it's only worth $500,000. That is not a good fact pattern for demonstrating a change in domicile. If we change the fact pattern a little bit and say, okay, they sell their historic home, they buy a much smaller townhouse up in New Jersey, let's say a townhouse for $300,000, and they then go down to Florida and buy a $500,000 condo. Much better fact pattern for trying to show, demonstrate that there's been a change in domicile. Alan?
The second domicile factor is business, and that's really goes to the business connections the taxpayer has from their former state of domicile to their new state. Unless it's a situation where one is retiring after many years on the job, the state really would like to see that taxpayers moving somewhere because of a new job, they're opening a new location, there's a reason for them business-wise to move to a new state of residence.
And I think one thing here, Alan, when we talk about business, even if a taxpayer is successful in demonstrating a change of domicile and everything else, if in fact there is a significant business connection, an office in New York that is visited, employment and everything, and the taxpayer is basically living in, let's say, Florida, and trying to conduct business from there and coming back and visiting every once in a while to do what they have to do up here to meet their employee needs, you have a situation where New York has what's called the convenience of the employer rule. So even if you were successful in showing and demonstrating that you had a domicile change, if the convenience of employer rule applies, and that rule states basically if you are working out of state for your own convenience as opposed to the convenience of the employer or the business, then all of that money that you're earning is still sourced to New York. So New York would have the right to tax that under that rule. New Jersey has kind of an informal program doing the same kind of thing. So it's something you have to be careful about, even outside of the domicile statutory residency issues. Alan?
The third factor that New York considers is time. And this is different from the 183-day, 6-month and a day rule for statutory residency. What states look at with respect to time is the quality of days that are spent in the state, in addition to the quantity of time spent in the new state versus the old state. So what do I mean by quality of days? Typically, taxpayers will spend the important days of the year in their primary residence, right? Everybody wants to have Thanksgiving dinner together. Everybody wants to open presents on Christmas morning together. So those would be days that one would be expected to be in their primary residence. So that's kind of one aspect of things. The second aspect is the quantity of days. And for that, we really want to show an uptick in the number of days spent in the new state. Many of our clients purchase homes in Florida, have had them as vacation homes for a number of years. And it's only later on that life changes and they decide to spend more time in their residency, in their new residence or their new primary residence in Florida. And we really want to show that there's been a significant change in the amount of time that they spent. Maybe it was 2 months or 3 months or a short winter stop in Florida versus, you know, a few years later when they're really setting roots down there, spending 8 months or so. Tom, if you want to tell them about the case. And
right, we just had Alan and I just argued very successfully, thank goodness, a domicile case for one of our clients in which we were able to demonstrate that the year before the audit period started, there was a certain amount of time spent out of state in their, at that time, vacation home. We demonstrated that after the change of domicile purportedly took place, there was an increase of 100 days spent in that southern state. Now, we prevailed even though the actual time spent in the southern state and New York were approximately the same, within 10 or 15 days. But because we could show that the amount of time spent in the the southern state was increased by 100 days, we won that. We won significant us winning that domicile case.
Factor number 4 are items near and dear, and for that, the auditor will look to see where a family's important heirlooms and jewelry and artwork is located. Again, the idea being is that these are going to be located in one's primary home, primary residence. So how do we prove that? So Tom and I often will have taxpayers, move in their wife's, jewelry onto their insurance policy of their new home, particularly when they're, maintaining their original home. We, transfer artwork. Usually we want those displayed in the primary residence. Packing slips are important for moving companies. We look to wedding albums. All those kind of added together set the stage that a taxpayer has moved the items near and dear from their prior state of residence to their new state of domicile. Then the final aspect that will be considered for domicile is the family aspect. There is a thought that a family really remains together. That's the presumption, particularly when there are minor children. You're really going to live wherever your minor children are in school. So that tends to be a factor in scenarios when you have minor children. If you have children who are already in college, they're out of the house, they live on their own, this becomes a much lesser degree of importance in the domicile situation.
There are situations, Alan's talking about the general rule. There are situations where you can demonstrate, for instance, that you have older parents that could be in nursing home situation or supported living, let's say in Florida, And, you know, one of the reasons that you're moving down there is to be closer to them. You can argue that, and there has been some situations where that's been successful. But in terms of New York taking the position, you know, with respect to the location of the family, as Alan said, it's usually limited to minor children and your spouse or partner.
So other factors, and we get this all the time. Client calls us up. I got a notice from New York, but don't worry, it's okay. I changed my driver's license to Florida. My vehicles are registered there. You know, I got Florida homestead for my property taxes in Florida. I'm a Florida resident. Unfortunately, those items are simply too easy to change, and they're not looked upon as primary evidence of a change of domicile. So while they do bolster an argument and they do add some credence to the story of a change of domicile, they in and of themselves, and we have a number listed here, do not show by clear and convincing evidence of a change of domicile.
I mean, I think it's very, very important that from the state's perspective, certainly New York, that you demonstrate, again, by clear and convincing evidence that you have the intent to change your domicile. And frankly, merely, you know, changing the location of your license, your driver's registration, your voting registration is not deemed generally enough to do that. By the way, when they do look at voting registration, they will look whether you demonstrate and exercise your vote, not just in the national elections, but in all the little school elections and everything else. They will go that far and look into that.
So again, just to wrap up domicile, you really want to show with clear intentions of a change of domicile. Often having that life-changing event is helpful to showing a change of domicile. And ultimately, you want to show that the taxpayer has not only left their original home, but also established roots in their new state of residence.
And what that means, frankly, is let's say you have a significant social connections and religious connections, etc., in your historic home state. You, in essence, should be looking to break those connections and reestablish them in the new state. So if you for years belonged to a temple or a church up in New Jersey and you have been members of that, it's very important that you at the very least establish new relationships in that regard down in the state that you are trying to demonstrate you have changed your domicile to. If you belong to a number of country clubs up here, New Jersey, New York, Connecticut, good idea to, as much as possible, you know, get out of those memberships and enter into new memberships down in the state that you're trying to demonstrate you moved your domicile to.
All right, so Tom, let's jump into some of the statutory residency issues that we see and some of the rules as well. The first here is the primary factors when it comes to statutory residency. Number one is a time test. Often that's 183 days. We've seen before, sometimes it could be 6 months, 200 days. There are various thresholds that are put out there by the states, but there always is a time element that's involved. And second point is having a permanent place of abode. So just because a taxpayer is in a state for the requisite number of days doesn't make them a statutory resident. They have to have a place to live within that state to show that they become a taxable resident.
Yeah, I mean, the important thing is any part of the day is considered a day in state. And the other thing is that, you know, you do not need to own a piece of property. You can rent a piece of property. And I have seen situations where individuals were held to be statutory residents. Famous case where a fellow who had a friend who was a priest and shared the expenses in a rectory but did not pay any rent. He was held to be a statutory resident of New York. I think when it comes to statutory residency, it's a very significant burden on the taxpayer to prove their location on any given day. The state doesn't have to prove that you were outside of New York. You have to prove that you were outside of New York. The state doesn't have to prove, rather, that you were inside New York. You have to prove that you were outside of New York, and the state will use a variety of methods of trying to determine your location. Alan?
So oftentimes when clients come to us in a residency situation, they often ask us, how can we prove where we were? Rule of thumb is if you can have contemporaneous documentation, you know, an Outlook calendar, something showing exactly where one is each day of the year, that's you know, the best documentation you can have.
Again, Alan, I think it's important that we just mentioned contemporaneous. That means that you, as the events occur, you are marking it down on the calendar, not the situation which we face oftentimes where folks don't have contemporaneous records. They try to look through any records they have and recreate a calendar after the fact. And it's very hard if, you know, you're being audited for 3 years to recreate 3 years worth of travel.
So what does the state look at to try to recreate those back years? And I often like to say Big Brother is always watching. For the most part, we're pretty good at figuring out where somebody has been in the past. The first thing we like to gather are credit cards. Oftentimes you'll see, for example, on American Express cards, it'll have the location of the charge. So that gives a pretty good indication as to where the individual was on a particular day. ATM receipts, Easy Pass records, office key card scans we've seen to be rather helpful for many taxpayers. You know, frequent flyer accounts, both for airlines, hotels. You know, for many people, they're big in gathering the points for being part of these programs. Oftentimes those records go pretty far back, so that's another reliable source of information. The last thing we've also seen, certainly in New York, and this is particularly for those who have AT&T or Verizon cell phone service. The state of New York has the ability to subpoena one's cell phone records. Your cell phone pings to the nearest cell phone tower at various frequencies throughout the day, and the state can subpoena records for either of those companies to shed light as to where the taxpayer was located. Now, it's not 100% foolproof because one can be in one state and the cell phone tower of another state could be pinged if that's the closest tower. But nevertheless, you know, it really does show a lot, or is a pretty good indicator as to one's location.
Yeah, I mean, they will also, to the extent that folks still are using landline phone records, they will, you know, pull your landline bills and everything else too. The question then becomes, what is a permanent place of abode? And a permanent place of abode is in essence, it has to be a permanent type residence. It has to have bathroom facilities, some form of functional kitchen, and in essence can be used. It's not a seasonal residence. It can be used. It has insulation during the entire year. New York, interestingly enough, we've got it here. New York has this rule that in order to constitute a permanent place of abode, it has to be maintained in the state for greater than 11 months. This is not regulatory or statutory. It's a policy that the state follows. And what that would mean is if you had moved into an apartment, let's say in New York City, in July, and you actually had your domicile in New Jersey but you worked in New York and you were trying to, you know, sleep, catch a little sleep during the week, you would not be considered a statutory resident for that year because you wouldn't have been there for greater than 11 months. On the other hand, for the following year, you would face the issue unless you left the New York City apartment prior to the end of November.
Another issue we see with regard to permanent place of abode are corporate apartments. We've had this issue come up a couple of times whereby a company, you know, would acquire an apartment, let's say in New York City, for the convenience of employees. The question really becomes who has use of that apartment, you know, under the terms of their employment. If various people throughout the company can crash there, that's one thing. Then it's not attributable to anybody. But if the apartment, let's say, was leased specifically for the CEO, as an example, because the company wanted him close, or maybe he was from out of state, this gave him an opportunity to at least have a place in New York to leave his belongings, that would be attributable to the CEO as a place of abode in New York as well as New York City.
Yeah, and I think the key here is unfettered access. So if you have unfettered access to an apartment or a house, that can be considered a permanent place of abode for you. I mean, we've seen situations where folks may try to put an apartment, let's say in New York City, under the name of their son or daughter, and try to avoid the, who may be, 23, 24, 25 years old, and try to avoid the situation of statutory residency in New York City. But if the parent has unfettered access, meaning that they can come in at any time of the day or night, even if they don't stay there that often, but if they can, that's considered a permanent place of abode for the parent.
So one question we often get asked after we've laid out the facts of domicile and changing it to a new state and making sure we're not in a state for more than a requisite number of days for statutory residency, it's how do you establish residency in another state? And most often, for our purposes in our practice, it's Florida. Florida being a no income tax state, great weather most of the year. A lot of our clients are looking to move down there. Now, because Florida does not have a personal income tax, they don't issue guidelines or have rules with respect to who or how to become a domicile or a resident. But there are a number of factors that we have listed here that can often be used to show an establishment of residency in Florida. And these points are used to build the story of domicile and to show that the change has been effectuated. So the first one that we have listed is the declaration of domicile. Some counties in Florida allow people to come and take an oath, get a signed declaration that they have changed domicile. Again, voter registration, licensing, an automobile, Florida certificates are important for that. Occupying the dwelling, being physically present in Florida is important. If you can, open a local office down there for your company, move your items near and dear. And of course, one of the major advantages to becoming a Florida resident is the homestead exemption for property taxes, whereby it limits the amount of property tax increases permitted by the state. You have to be a Florida resident for that. So oftentimes, bundling that together with these other items can show that that one has in fact landed in Florida and become a Florida domiciliary. So let's just touch upon very briefly the concept of community property versus separate property state. And this often comes into play when spouses may work in different states and they have different income from different states. Again, the state where that income is earned is where it can get taxed. So in a community property state, both spouses are required to file a return together versus a separate property state where only the spouse that has earned the income in that state has to file a return. Again, the advantage to a separate property state is that the spouse who is not located in the state doesn't have to become subject to that state's taxes. We've listed some states that do follow the community property rules. The major one being California, that oftentimes we'll see clients of ours, a spouse will be relocated to California for job purposes, whereas the other spouse remain in New York. Unfortunately, the taxpayer in New York will have to be included on the tax return of the other spouse in California, leading to some possible double taxation.
You want to talk about some of these audit issues you got listed here?
Yeah, so let's move into some of the big things. And the number one issue we come across, or the biggest item that triggers a residency audit, is the fact that a taxpayer in year one files a resident return in a particular state, and then year two files as a non-resident. And the idea being is that the taxpayer moved as of the first of the year. No taxpayers move on January 1st. I don't know any moving companies that work on January 1st. It is a huge red flag, and it is easy for a state to pull a return because of that filing. Oftentimes, we like to see a partial year return being filed, whereby a taxpayer has moved somewhere in the middle of the year and therefore files two part-year returns, one for the resident state and then another one for their old state of residence.
Yeah, I mean, I think to be honest with you, someone had just jumping a little ahead here, someone had sent us a question: is what kicks off an audit? Alan's listed some of the items here that do kick off an audit, but frankly, particularly when you have a situation where you've got an individual that has somewhat higher net worth, New York State is not going to focus that highly on folks that have, and I hate to say, $50,000, $60,000 worth of income moving out of state. You have folks that are in the seven-figure category or greater. They are going to look very hard at that. So one of the things going to trigger an audit is exactly in that situation when you have been filing historically residence returns rather, and then in 1 year you file as a part-year resident as opposed to a full-year resident. They're going to look at that and say, okay, are we sure that person is no longer a resident of New York or New Jersey or Connecticut for that matter, and look very closely at the factors that we listed. One of the things that's important here is that once you can demonstrate that there's been a change of domicile, as opposed to having to address the statutory resident, but once you can change that you have demonstrate that there's been a change of domicile, that audit issue should be laid to bed forever, unless you've had a significant change in your lifestyle going the other way. But you'd still have to face the statutory residency rules, but you can prevail on domicile hopefully only once and have to face it and win. Go ahead, Alan.
Yeah, another big audit trigger is When someone files as a non-resident return in the state of their historical state of residence, and there's no sale of their original family home. That means that they've kept some sort of connection with the state that goes back to the domicile factors that we talked about at the beginning of the presentation. And, you know, the states get a copy of your federal return. And on your or one's, you know, federal return, if there's a sale of a residence, that income, that sale or loss will be picked up on one's tax return. Since it's located in historical state, it's earned in that state, any income, and a tax return would have to be filed. They will have record of that. The historical state will know whether a taxpayer is in fact selling their home or not. And if there has not been a sale of the home, oftentimes that can you know, trigger a residency audit. Other things that states do is they tend to send out non-resident questionnaires. You know, if they see that there's some sort of activity, if a taxpayer falls onto property tax records, something of that nature, that can trigger an audit. But ultimately, it's about filing the returns, having the requisite income, and whether one has in fact changed their residency with the various factors we've touched upon before and made sure to spend more time in the other state.
Okay, Alan, with that being said, you know, we're going to open it up to some of the questions that we received, and if anybody wants to send in additional questions. By the way, as we start, if we don't get to a particular question that you sent, it's because we've received quite a few, and we will be happy to address those if you reach out to either Alan and I individually. One question we've got here is from an individual who owns a piece of real estate in Manhattan that they've lived there for about 10 years or so. They'll be selling that piece of real estate and hopefully establishing domicile in Florida. And how does that affect that? Well, I think in that situation, you've got, you know, real estate that is located in New York. You're going to be selling that real estate. In this case, it was a co-op. It's going to be selling the shares of the co-op. That's going to be the gain from that sale is going to be sourced to New York since it's real estate located in the state, notwithstanding that you've moved, hopefully successfully, your domicile to Florida. You know, you need to consider that the states are very particular about, you know, taxing state gain is generated from the sale of real estate within their geographical boundaries.
Another question we have here is with respect to day counts and husband and wife, and whether those are deemed to be unified or separate. And Tom and I have done many audits whereby one spouse meets the requisite day count, but the other spouse does not. Technically, each spouse should be viewed independently for both domicile and statutory residency purposes. Income is typically earned by one resident or the one spouse or the other spouse, and they could be attributed accordingly. But however, note, particularly with respect to domicile, the location of the other spouse does impact, you know, the weighing of the factors. So while they are viewed separately, there is some crossover between the two. It is possible that one spouse could be deemed a resident of a state and be taxed upon their individual income, and the other spouse not be a resident of that state.
Yeah, and we've seen this often in situations where you've got, for instance, someone who could be a statutory husband could be a statutory resident of New York City, wife has a business out on Long Island, and in that situation, you can have one, you know, individual of a married couple be be deemed a statutory resident of the city while his wife or husband is not. We got another question here, has to do with you have a vacation home in a particular state, and you spend a significant amount of time there. In this case, I think the question listed 180 days, and then you then for family emergency purposes, in this case the death of a family member, you're come into the state and you spend greater than 183 days in there with that added time. I think two things. One, I think you're out of luck, frankly, in that situation for the most part. Secondly, I would advise that if you've got a 183-day rule, do not get up to around 180 days. On audit, the auditors tend to, when they get up that high, they smell blood in the water like a shark, and they're going to dig in. So I would recommend that if you're in that situation, you want to keep your day count 100 and 160, 165, because a lot of times, they'll find a few days that you didn't count on upon audit. Alan and I deal with that oftentimes. They're very detailed in this. They look at these records that they're pulling very closely.
Yeah, I would just add that there are really two limited exceptions for day count purposes, statutory residency. One being a travel day. If all you're doing is passing through the state to travel out of, we have that often with taxpayers who will fly up to New York to JFK and then immediately transfer planes and fly out of New York. If all you're doing is staying in the airport and jumping on the next flight, that's okay. If you leave the airport to go out to a restaurant and come back later on, that's a no-no. That would be considered a day. The other exception that's out there is if you have inpatient hospital care, you come to a state because that's where they have the best doctors, and you're having inpatient care, not outpatient care, but inpatient care, that would be exempt. But that's only for the patient. So if a spouse comes with that individual and spends time, helping them in the hospital, those would be, statutory residency days for that individual.
Yeah, and in this question where you have a family emergency, such as a passing of a family member, there's no exception for that. And even though it's obviously a very sympathetic situation, I haven't seen it prevail on audit ever.
So another question we've had that comes up is, can one prevail with respect to domicile, but be stuck with regard to statutory residency? And oftentimes, the facts and the situations upon audit do come down to that. We're able to prove that the taxpayer did have enough facts in their favor that they have changed their state of domicile, yet due to day count, maybe it was a family emergency or something of that sort, they've therefore exceeded the requisite number of days in their historical state of residence. That, while painful for that year, we often find is a good thing in the long run, because, as Tom mentioned earlier in the presentation, once you're able to establish a change of domicile, that continues. So while there may be some hardship initially because of the statutory residency day count going against the taxpayer, in the long run, they've established with the taxing authority that their domicile has changed.
With that, I'd like to thank all of our listeners, and hopefully you found this beneficial for you. Sorry we didn't get to everyone's question, but again, if you have individual questions that you'd like to pose to Alan and I, please feel free to reach out to us. We'd be happy to discuss them with you. Again, thank you very much, and good afternoon.